Assalamu alaikum. Welcome to lecture 7 of ATX, and today we are going to cover pension. Here we are going to go through the different pension schemes. How do we get the tax relief for the pension contribution that we make? The method of obtaining that tax relief, as accessing the pension, and summary. So here we are going to discuss the pension scheme for both employed and self-employed. And for employed, there are two options, occupational and personal. But for the ones who are not employed, who are self-employed, for them it's only personal pension scheme. Under occupational and personal, we are going to go through how are we going to get the tax relief under both the scheme. How do we obtain that tax relief and what is the impact of lifetime allowance? Now, so investing in a pension scheme, okay, this is a long-term investment and is very tax efficient for the following three reasons. Number one, they get tax relief. Individuals get tax relief on the contributions they make into the scheme. Second, where employees also contributes into the scheme, there's a tax relief for the employer's contribution also. And this is not a taxable benefit for employee. Okay. Third, pension scheme in the fund can grow tax free. Why? Because this scheme is exempt from income tax and capital gain tax. And when you are retiring, so there's a fourth. On retirement, part of the fund, remember, part of the fund can be withdrawn as a tax-free lump sum. Lump sum means at once you are taking a huge amount. That is the meaning of lump sum. Now, types of pension scheme. There are two, occupational and personal. Personal is applicable for all, occupational only employees. First, we are going to go through occupational. Occupational pension scheme, this is set by the employer for the benefit of their employees. As the word occupation, you can understand, right? You need an occupation, you need a job for it. And employees may automatically be enrolled in that scheme depending on the size of the employer, or they might choose not to enter the scheme. Okay, rather they might set up their own personal pension scheme that is there, or employees could contribute both in the pension personal and occupational scheme. Now, occupational pension scheme, so occupational pension scheme, okay, contribution in this scheme could be made by both employer and employee. Now, under occupational, it is divided into further two categories, defined benefit, money purchase. Okay, occupational pension schemes are divided, sorry, they are not divided into two, I'm so sorry. Occupational, it could be defined benefit or money purchase scheme. We'll see what it means. Defined benefit means based on the level of the earnings an employee is getting the benefit when they are retiring. This is linked to the level of the earnings of the employee. Money purchase, it is known as defined contribution. This is based on the performance of the investment. That means in that fund, how much is there at that time when you are retiring. Whatever is there, you will get it. Now, for personal, okay, this can be set up for by those also who are not working, like children. And contribution could be made by individual, third party on behalf of individual. For example, it could be an employer, a spouse, a parent, or a grandparent. And personal pension scheme falls under money purchase. Okay, they are more like money purchase scheme. And occupational is more like defined. Now, next. So we have understood the two types of scheme. Now we want to know what are the rules for the tax relief. Amount of the tax relief, okay, is the same whether you choose to contribute in occupational or personal, doesn't matter. The tax relief that you are getting on the amount that you are contributing is same under both the scheme. But the method that you obtain that relief, tax relief, is different depending on the scheme that you are choosing. Now, once the funds are invested in the scheme, all pension schemes are governed by the same rules. Now, Regardless of the level of the earnings, an individual can make contributions of any amount. It's not fixed that they only have to make contribution up to this much. Any amount of pension contribution could be made in the scheme. Okay, it could be one single scheme, it could be a number of different pension schemes. But remember, the tax relief you will not get for any amount of pension contribution. No, the tax relief is only available for a maximum annual amount each tax year. So what is this maximum annual amount? We'll see it later. Now, the amount that you are getting the relief is the higher of this two figure, 3,600. That means minimum you are going to get contribution 3,600. You will not get a contribution tax relief below this. Okay. Next, 100% of the relevant earnings. What is relevant earnings? This is very important. Not all the earnings are relevant earnings for pension. Okay. And hence chargeable to income tax in the tax year. So relevant earnings. Okay, for your understanding, I've included the definition of relevant earnings. Relevant earnings are your trading profit, are your employment income, furnished holiday accommodation. This I finished in my previous lecture, lecture number 6. They have explained what this furnished holiday under my property and investment income lecture. So please go back there and check. Employment income I finished in lecture 2. Trading profit I finished in lecture 3 and 4. But remember, investment income are not relevant earnings. So if you are given 5-6 types of earnings, don't include all the earnings. First see whether it is relevant or not. If it's not relevant, you don't include it, it is excluded. And then take 100% of that. 100% means just the addition, right? You add all and the full amount you get. So if it's more than 3,600, you get a tax relief on that. If it's less than 3,600, 3,600 is the relief. Now, you need to note one thing. The maximum limit applies to the total gross contributions made into all the schemes. Remember, this maximum limit is for all the schemes, whether personal or occupational. Okay. So this is where an employer contributes to both occupational and personal, or individual contributes more than one personal. So what if an individual does not even have any relevant earnings? No trading profit, no employment income, no furnished holiday accommodation. Still, he will get a tax relief up to 3,600. So that's a good thing. Now, personal pension contribution. So here, remember, whether an employee contributes, a self-employed individual contributes, an individual who is not working contributes into the personal pension scheme. But the method of obtaining tax relief is same, irrespective of who contributes in the scheme, doesn't matter. So this is how relief is given. If you are a basic rate taxpayer, automatically it is deducted at source at basic rate. Basic rate is what? 20%. We are taking the non-savings, so basic rate. So when you are making the contribution, it is deducted at source. That means any payment that are made to the pension fund are net of 20% tax. But remember, this payment is ignored in the income tax computation. Now, for higher and additional, for higher it's 40%, additional is 45% tax relief. This is how it's given. 20% at source, and the balance. If it's 40, then the remaining 20 through income tax computation. Or if it's 45, the balance 25 through income tax computation. How? You extend the basic rate and the higher rate limit by the gross contribution. So that means if you are extending your basic rate, that means now more of your income will be taxed at basic rate, which was supposed to be at higher rate. Or if you're extending higher rate, means more of your additional rate will be now charged lower at a higher rate, which is beneficial. So this is good. Okay. Now, remember PA. PA is personal allowance. In my lecture, what I've told you, personal allowance is restricted for high earners. In this case, we are taking adjusted net income over 100,000. And there I've told you how to calculate also adjusted net income. If it's more than 100,000, personal allowance will reduce. Okay. So in calculating ANI, we also take the gross amount of personal pension contribution. Remember, it has to be personal pension contribution. Most of the time in your ATX or tax, they usually give you gross contribution for personal pension contribution rather than occupational. Okay, so they are testing more on personal. You don't have to do anything, you just have to deduct this from your adjusted net income. First calculate adjusted net income, then from there deduct the gross amount of personal pension contribution, and whatever your amount is, if it's less than 100,000 you get the full personal allowance. If it's more than 100,000, personal allowance will be reduced. Now, occupational pension contribution. Here, employee makes the payment gross. Here the payments are made gross. And how is the tax relief is given? Through payee system. That means you reduce the earnings subject to tax. And remember, the payment that you're making to the scheme, this is an allowable deduction from employment income. You can deduct this when you're calculating your employment income. Now let us do question. Test your understanding 1 and 2. So here we have two questions. Now, first one, explain how tax relief will be given for each individual. Two individuals are there, and you need to calculate the income tax liability also for Dante only. So you have been given ESMA and Dante. Okay, these are the contributions they have made gross, and these are the trading profits, 20 and 100. So let us quickly do that. Remember, in ATX you have to be prepared to explain. Okay, work on this part. I know most of you know how to calculate income tax. You'll be quickly able to do that, but when it comes to explanation, often students fail. So first we'll write ESMA. Under that we'll write in bullet points the points how he will get the tax relief. So remember, first, to get the relief, it is higher of what? Each time you have to check whether it is 3,600 which is higher, or 100% of relevant earnings. What is this relevant earning in this case? It is just the trading profit. 100% of 20,000 and 100% of 100,000. So 100% of 20 means 20,000. So 20,000 is higher than 3,600. Automatically this is your tax. This is the amount on which we are going to get the tax relief. This you have to explain line by line. Okay. So how is she going to get the tax relief? You have to talk about relevant earnings and all. 100% of relevant earnings in the first. Next, and say is 20,000 because it's higher than 3,600. Then what? Basic tax rate relief. Basic rate tax relief at source. This you have to explain. What is the basic tax? 20%. So 20,000 into 20% is 4,000. This will be deducted at source. Okay. So how much is your pension contribution? 25. You have to deduct 4,000. You're going to pay 21,000. You have to pay net. So she has to pay 21,000 in the pension scheme. Next, you have to say whether she's a higher rate, additional rate, or a basic rate taxpayer. At what level she is. This you have to explain. So looking at her trading profit is 20,000. She's a basic rate taxpayer. So because ESMA is a basic rate taxpayer. Now, in other words, you can say as ESMA is not a higher rate taxpayer, you should not make any adjustment. No adjustment is required to our income tax computation. Nothing will happen in her income tax because basic and basic. She's getting a relief at basic rate. She's a basic rate taxpayer. No difference. Difference will come in Denti because she's a high rate taxpayer. Look at it. It's 100,000. More than 37,700. So for Denta also, we'll see. It's 100,000. This is higher than 3,600. Oh, I'm so sorry. There's a thing which I've missed out. So when you're taking 3,600 and here we have to 20,000. 100% of 20,000. This we have took because here pension contribution was 25,000. It was more. Remember, your contribution, okay, the tax relief on your contribution will be restricted to the 100% of the relevant earnings. Okay, here if you are taking 100% of 100,000, it is 100,000, yes, but the tax pension contribution was 40,000. And if you see, the pension contribution is less than his relevant earnings. So she will get a tax relief for the entire 40,000. And out of this 25,000, in the first one, she will get a tax relief for 20,000 because 100% of this is less than the pension contribution, right? If you are taking 100% of relevant earnings, it should be less than your pension contribution. If it's less, I mean, you will get up to that amount. But if pension contribution is more, you will get on this entire amount, whatever you have contributed. So in this, sorry, if you are contributing less, then the amount on which you are going to get a tax relief. Okay, let me explain this again. So this is 25,000 in ESMA's case, and your 100% relevant earning is 20,000. That means you are going to get tax relief. This is restricted to 20,000, isn't it? And from here you can, that means out of 25, on the 20,000 you are getting the tax relief because you have contributed more than this amount. You have contributed more than the amount on which you are going to get tax relief. Coming to the second situation, you have contributed 40,000, 100% of relevant is 100,000. You are going to get the tax relief on this entire amount because it's less than the relevant earnings amount which you have contributed. That means less than relevant earning is less than the amount on which you are going to get the tax relief. So entire amount you are going to get tax relief. And here also basic rate 40,000 at 20%, which is 8,000. Okay. Now so from 40,000, okay, pension contribution is 40,000. So from 40, 8,000 is deducted. You have to pay in the contribution 32,000. And if you see trading profit is 100, then I is a higher rate taxpayer. He's going to get a benefit. You extend the basic rate. How? Extend the basic rate. By how much? By the gross contribution. What is the gross contribution? Remember, gross contribution, not net. Gross contribution is 40,000. And on that 40,000 whole, you are going to get the relief. So basic rate is 37,700. With that add the gross contribution of 40,000. Now your basic rate band will be 77,700. That means up to 77,700 you will be taxed at 20%. What about personal allowance? Your trading income is 100. The moment is 100, still you get full personal allowance. The moment it starts exceeding 100,000, personal allowance will be reducing. Since it is just 100,000, so personal allowance, see this is trading income. Personal allowance will be 12,570. Never forget to deduct personal allowance from your trading income. That is your taxable income. 87,430. This is all non-savings. Out of this, 77,700 would be taxed at 20%. The balance, that is 9,730 at 40%. And you get the tax and you will get the total. Okay, you will get the income tax liability. Get it by yourself and check with the answer. Now, test understanding 2. Yona is getting a salary of 80,000. She's a member of occupational pension scheme. Pays 3% of her salary in the scheme. No other income is there. Calculate income tax liability and show how tax relief is obtained for pension. This is occupational now. So remember, from salary, when you are making a contribution into occupational, you can deduct it from salary. It is allowable expense. And how much? 3% of the salary. So from 80,000 salary, deduct 3%. That is the contribution you are making. 3% would be 2,400. which is 77,600. Next, deduct personal allowance. This is employment income, 12,570. 65,030. Here, remember, we don't expand basic rate or higher rate or do anything. Just calculate tax on this amount. Okay, 37,700 at basic and the balance at 40%. And remember, the employer's contribution into the pension scheme is an exempt employment benefit. That's why we don't. That's why it is not a taxable income for you now. Okay. Next, we have relief for contributions by employers. Okay. This is tax deductible when employers are calculating their taxable trading profit, provided contributions are paid for the purchase of trade, and it is an exempt employment benefit for the employee. Added to the pension contributions paid by employee on which tax relief is given to determine whether the annual allowance has been exited or not. Because if annual allowance is exited, there is an income tax charge on it. We'll see it shortly after some time. What is this annual allowance, how much it is, and what is the income tax charge? So whenever an employer contributes, even this is added to the employee's contribution to decide whether you have exited the annual allowance or not. Now, the deduction against the employee's trading profit is given in the accounting period when the contribution is paid. Accounting treatment is not followed. That means it's cash basis, not accrual basis. Illustration 1. So illustration 1, we have 3 people, okay, of whose you have to calculate their pension contribution on which they can obtain tax relief. And explain how the tax relief will be obtained. It's by you, Holly, and Holly's employer. So we'll read. Hugh is a self-employed builder and tax adjusted trading profit has been given 80 and 90. Hugh's wife has employment income 13,500 and property income 20,000. Joint bank account they have where they are earning interest of 5,000. Hugh paid 19,400 to personal pension scheme. Holly paid 2,600 into her employer's occupational pension scheme and Holly's employer contributed a further 2,000. So we'll deal one by one. First Hugh, then Holly, and then Holly's employer. So first we'll write Hugh. So for Hugh, the first point, he can obtain tax relief for what contribution? 100% of his relevant earnings, right? What is 100% of his relevant earnings? For which tax year? 23-24. They asked for 23-24. Okay. So 100% of relevant earnings. He's going to get tax relief on 100% of relevant earnings. Now, what is his earnings? 90,000. This is the relevant earning for this tax year. The 80,000 falls in the previous tax year. 90,000. Right? Remember, for relevant earnings, it's only trading profit. The investment income, this earn interest, okay, is not a relevant earning. Only the trading profit. This you have to write. Investment income is not relevant. Therefore, not included. Next. He will pay the pension contribution net. This is in the personal, right? Net of basic rate tax. So what is net of basic rate tax? What is the contribution he's paying? 19,400. 19,400 into 20%. Is it correct? Is it correct? See, this amount 19,400 is net amount. How do you know? If it was a gross amount, in bracket they would have written gross. If they don't write gross, always assume it's the net amount. Understood? So if you do like this, you are again taking 20% out of it. Already 20% has been taken on some amount. That's why you got 19,400. So this is wrong. This is what I wanted to show you. If something is a gross payment, they will specifically mention gross. If they don't mention anything, it's net, because basic treatment is any contribution into personal pension scheme are always net. Understood? So what do you have to do? 19,400 into 20 divided by 80. That's 20%, and then 100 minus 20. 20, 100 minus 20. This is the way you have to do it. You want to find out just the tax. How much tax has been cut? The other way you could do is gross up this 19,400 into 100 divided by 80. You will find a gross amount. Something you will find out. By that gross amount, deduct 19,400. Y minus 19,400. The difference you will get is 4,850. This is the amount. The tax amount we want to find out. This is what we are doing. 4,850. Try it yourself and check. Now, what is the gross? You have to find the gross, because you have to extend your basic rate by gross only. This is how you gross it up. 19,400 into 100 divided by 80. It's 24,250. This is the gross amount. So check whether it's a high rate or not. Looking at 90,000, he's a high rate taxpayer. Therefore, you extend the basic rate. 37, this is the next point. 37,700 plus 24,250. So basic rate is, now the new basic rate would be 61,950. Coming to Holly. We are done with Hugh. Now we are moving on towards Holly. So for Holly, what are her relevant earnings? Relevant earning is salary 13,500. This is a relevant earnings. Remember, property income is not a relevant. Okay, so we don't include the property income. So it would be 100% of 13,500 or 3,600. So it is 13,500, which is higher. Okay. Now, if you see her gross contribution, so it's 13,500 is higher than 3,600. Up to this much she'll get tax relief. And she have contributed how much? 2,600. That means this 2,600 is fully eligible for the relief. It falls under this one. It's less than 13,500. So that means she can obtain tax relief for this 2,600 made. What happens now? So Holly's employer, what would Holly's employer do? He will deduct this 2,600 from his employment income. From the employment income before calculating income tax liability under payee. This you have to write. Now, how much Holly's employer contributes? 2,000. Remember, this is exempt for Holly. It's an exempt benefit. Now coming to the Holly's employer. Holly's employee will get the tax relief on that 2000 because he have invested 200. He will get the tax relief. How is the relief given? For employer, you can deduct 2000 from employment income. No. Remember, he's an employer. He will not have an employee's income. It is not a salary for him. He can deduct this from the trading profit, employer's taxable trading profit. He's a self-employed person. So for him, whatever he have contributed, he can deduct while calculating his profit. Now, contributions in excess of annual allowance. There is no limit to the contribution. Okay. But tax relief is limited. And maximum amount, the annual allowance is 40,000. After that, if you are contributing, there is a tax that you have to pay. That means total of all the gross contributions, it could be by the individual, by the employer or third party, has to be in the limit of 40,000. Now, good thing is this you can carry it forward. This unused annual allowances can be carried forward. Okay. From the previous 3 tax years. So you can bring this forward from the previous 3 tax years. Now, so any unused amount can be carried forward. Remember, if the individual was a member of the pension scheme for that tax year, otherwise you can't carry it forward. Otherwise it's lost. And first you have to use the current year's annual allowance. Then you have to use the previous year. How are you going to use the previous years? Starting with the earliest tax year, FIFO basis. Now let us do question. Test your understanding 3 and test your understanding 4. 3, we have 2 people, Danjam and Hassan. With 3 years of gross personal pension contribution and relevant earning is 110. Now, Danjam was in the pension scheme since 1213. That means all 3 tax years he can carry forward. But Hassan is from only 21-22. That means only these 2 tax years he can utilize. Maximum contribution, you have to state that both of them can make without incurring an annual allowance charge. So, first we'll do Danjam. Danjam, if you see this year, he can't carry forward anything because he have contributed more than 40,000. Okay, so it is 0. And here it is 35,000 in the second year. So it would be 5,000 because 40 minus 35 and here 40 minus 17, 23. So if you add 5 and 23, total is 28,000 with 40,000 for this year, total 68,000 that Jem could contribute. Coming to Hassan, Hassan can't carry this forward because he was not a pension member. He was not a member of pension scheme that time. Here it's 5,000, here it is 6,000, here it is 35 and 34. You have to check minus the balance with from 40 and 40,000 of this year. So if you add all is 109,000 that Hassan could contribute without incurring any charge, annual allowance charge. Coming to test understanding 4. 4, if you see, 4 years are given. This is for Ahmed. Relevant earning is 150. You state the amount of unused allowance to carry forward as a tax year. So here we'll make a table now. Allowance away level. Unused 23, 24 and carry forward. Okay, it is for 24, 25. The next year they're asking. See, this year, you have an unused, but here we have used it. That's more than 40. That's why we are saying it's not unused. I'm sorry, it is used. So here, allowance for 23-24. Allowance was 40,000, but he have used all this 40,000, so nothing to carry forward. Now unused, starting from 20, 21, 21, 22, 22, 23. Remember one thing, when we are in this year, we can go back 3 years, 1, 2, 3. But when we come here, it's only from this year. This is our first, second, and third. We are still right now in 23, 24. Because here, we have to bring forward from this year, and this year. Because we have utilized more in 23, 24. So first we have to bring forward. It's a double work. So first we have utilized 12 here. This would be 28,000 we can carry forward. Here's 36, so 4,000. And here it is 33, so 7,000. This will write here. Allowances unused. 28,000, 4,000, 7,000. And if you see, 79,000. How much did we utilize here? See, it's on a FIFO basis, okay? If you see here, we have used from 58, from 40, we have used 18,000 more. That 18,000 more would be utilized against this 28,000 first, because it's on a FIFO basis. So this is 0. Then we are only left with 4,000 and 7,000. 11,000. This is 58,000. 40,000 from the current year, 18,000 from the 2021, 28,000. This 28,000 unused, we are using 18,000. So 11, you can carry forward to 24, 25. Now, remember, allowance for the current tax year has to be used first, then the unused allowance for the previous 3 tax years, starting with the earliest tax year. Now, what is the remaining allowance? See, if you deduct 28 and 18, 10,000 is remaining, no? What do we do with this 10,000? You can't carry it forward to 24, 25. Why? Because it's more than 3 years. See, here we have 28. We have utilized 18,000 of this. So we are left with 10,000, right? In 2021. We can't take it to 24, 25. It's more than 3 years. That's why. So it's lost. It's wasted. So now we'll calculate the annual allowance charge. Now, where the total of all the contributions on which relief has been obtained exists annual allowance, including brought forward annual allowances we are talking about current year, as well as brought forward annual allowances. If this exists, then there's a tax charge on the excess. Now, why pension was very important from the very beginning. Even this is saved as non-savings. This also you have to tax in your income tax calculation. So the tax charge, you have to put it there as the top slice of income. Remember, this is taxed last after all the sources of income, including dividends. First we save non-savings, then savings, then dividend. After dividend, this is taxed. But it is taxed at the non-savings rate, non-savings income rate. And the income does not count towards adjusted net income. Remember, this income is not included in the adjusted net income. Excess would be taxed at 20, 40, 45% depending on the tax position of the individual, at what level he is, whether it's a higher rate, basic rate, or additional rate. And it is added to the individual's total tax liability. And it is either paid through the self-assessment system or maybe taken from the individual's pension fund. Now let us calculate an annual allowance charge through a question. Test your understanding 5. Calculate income tax liability of Marcus. Okay. Marcus has been employed, set up personal pension, earn 110, gross contribution 50, contributes 50, in pensions is 20, 10, 11, employer contributes further 30. Okay, so now calculate. Okay, so we'll calculate, but I'll be explaining you the points. Okay, see here, employment income is your net income because you don't have any other deductions to make or any other income to be added. Okay, so your employment income of 110, this is equal to your net income. Okay, 110. The moment it's more than 100,000, we know personal allowance will reduce. But here personal allowance might not reduce, we'll see. We have to do a working for it. What is it? We can extend, we can reduce the gross personal pension contribution from our employment income. So what is it? It is 50,000, right? What is the gross? Already they have given you gross. So 50,000, right? 50,000 if you deduct from 110, it will anyway be less than 100,000. That means he is eligible for the full personal allowance 12,570. So taxable income is 97,430. Remember, because personal contribution is there, his basic rate band will be extended by the contribution 37,700 plus 50,000. So 87,700 would be taxed at basic rate. And the balance 9,730. Okay, just take this two balance, would be taxed at 40%. But remember, with this, you have to add another thing. That is the annual allowance charge. Annual allowance charge would be taxed at 40%. What is the annual allowance charge? How much? We'll see that. Okay. So first we'll understand how much tax relief he can obtain for the gross pension contribution. He has contributed 50,000 up to 110, 100% of 110. That means on this full 50,000, he's going to get a pension contribution. That means this, it is personal, he's going to receive it net. 50,000 into 20%, which is 10,000. So that means he's going to pay 50 minus 10, 40,000 in the pension. Okay. Now we have extended the basic rate band. And what about the employer's contribution of 30? We don't do anything here, but for them, for the employer, when they are calculating their trading profit, you can deduct this 30,000 there. It's an allowable deduction. So what is the total gross contribution? Remember, when we are taking the total gross contribution for the relief, we are taking 50,000 of the employee, 30,000 of the employer. We have to add both, and it's 80,000. Well, 80,000 is more than 40,000 annual allowance. If it's more than 40,000 only, you have to pay tax. How much? The difference is 40,000. So this 40,000 only will be taxed at higher rate after taxing the non-savings income. This is an annual allowance charge. This will be added with your income tax liability. Okay. So that you have to add. And remember, what about the brought forward? Remember, there are no annual allowance brought forward. Because previously also you were making contributions of 50,000, 50,000, 50,000 every time. So it's less, it's more than 40,000. If it was less than 40,000, only unused annual allowance you can carry forward. But since already in the previous year you're making 50,000, 50,000, you can't carry it forward. There's nothing to be carried forward. It's greater than the annual allowance. Okay. Now, Restriction of annual allowance for high income individuals. If you are on high income, your annual allowance will be restricted. How? This is how. Remember how we used to deduct personal allowance, high income and additional rate taxpayers? Same way. For annual allowance also we reduce for high income individuals. This restriction is like this. If it exists 200,000, if threshold income is something else, adjusted income is something else. They are not the same. If your threshold income is more than 200 or adjusted income is more than 240, restriction, it will be restricted. This is how it is reduced. This formula you need to remember. Adjusted income minus 240 into 50%. How for personal allowance we have adjusted net income ANI minus 100 into 50 like this. The only thing is number is changed. If necessary, the reduction has to be rounded up or down to the nearest bound. Maximum reduction, remember, is 30,000. Sorry, 36,000. That means minimum annual allowance an individual will be entitled to is 4,000. Why? What is the annual allowance? 40,000. How much you can reduce it by? 36. 40 minus 36, 4,000. So the minimum level, that means beyond 4,000, it will not fall down. Minimum, that's the floor. 4,000 is the limit. So maximum you can reduce by 36, it will fall to 4,000. Now, this is how you calculate threshold income. Take the net income from income tax computation. This I have done in my lecture 1. Deduct any gross personal pension. See, gross personal pension we used to deduct from our net income for personal allowance also. It's the same threshold income. Now, if it's more than 200, remember, if threshold income is more than 200, then you calculate adjusted income also. Take the net income plus the employer's occupational pension contribution. Occupation. Okay, employees occupational pension contribution, not employers, employees. And add employer's contribution into any scheme. It could be personal, it could be occupational. For employer, any scheme. For employees, only occupational pension scheme. Add it with the net income and you will get the adjusted income. Please remember the formula for this too. We'll do questions on this too now. Now, if the adjusted income is 312,000 or more, automatically it will be reduced by 36,000. That means annual allowance will be 4,000. Why? Because put that 312 there, minus by 240 into 50% and check how much. The reduction cannot be more than 36,000. That's why. Now, adjusted income for pension and adjusted net income for personal allowance are not the same. Do not confuse the two. Adjusted income, there is a no deduction for gross gifted donation, no individual's gross personal pension. But for personal allowance, we do that. Sorry for, yeah, personal allowance deduction, we do that. Here we don't deduct. And also, employers' pension contributions needed to be added to the net income. However, as adjustments to the net income, to calculate adjusted income, all relate to employment. For the purpose of your ATX exam, adjusted income for self-employed individual will be the same as net income. So adjusted income and net income for self-employed will be same. Okay. Now, if threshold is less than 200, if threshold is more than 200 but less than an adjusted income less than 240, annual allowance is 40,000. No restriction. Remember, once again I repeat, if your threshold income is less than 200,000, no restriction, full annual allowance of 40,000. If your threshold income is more than 200 but adjusted income is 240 or less than 240,000, still you are eligible for the full 40,000 annual allowance. The restriction only comes when both your threshold income is more than 200,000 and adjusted income is more than 240,000. Then it is reduced by this amount. Adjusted income minus 240,000 into 50%. Now let us do question. Test your understanding 6. So test your understanding. 6. We have 4 people. Anne, Belinda, Carol, David. You have to calculate the annual allowance, assuming there are no unused allowances brought forward for this tax year for all the 4 people. Gross contribution has been made to both occupational and personal. Employer's contribution is also there. Net income has been given to you. So things are very easy, right? First, what do you have to do? Calculate the threshold income. So let us quickly do that. Anne, Belinda, Carol, David. First, we need net income. Then we need less PPC, personal pension contribution, to find the threshold income. What is the net income? Already is given 190, 215, 250, 270. Just copy paste here. Deduct gross personal pension contribution. It is 23,200. Not the occupational, only the personal. So it is 167,000, 213,000, 250,000, 270,000. So tell me, looking at it, this one, threshold income is less than 200,000. So no reduction. Full, he is eligible for full 40,000 annual allowance. Coming to Belinda, Carol and David, all these three, it's more than 200,000 threshold income. Now we need to calculate what adjusted income. So we'll do that. Remember, adjusted income for Anne is not applicable, okay? Only for Belinda, Carol and David. B, C and D. So adjusted income is net income plus employer's contribution into any scheme and employees occupational pension scheme or occupational pension contribution, OPC. So net income is already given 215, 250, 270. So we'll see here. These things we have to add and this part. So here 0, 0, 12, 20, 20, 28. So we'll quickly add that. Employees contribution. 0, 20,000, 28,000. Employees 0, 12,000, 20,000. If you add 215,000, 282,000, 318,000. Remember, this one is less than 240,000. Therefore, full 40,000 he will get. He's eligible for full. Okay, but for Carol and Devinda, it's more than 240. Their annual allowance will reduce. Okay. So now we'll do for Carol and David. What is the annual allowance? 40,000. How much you can reduce? See, this is 282 minus 240,000 into 50%. is 21,000. Remember, maximum deduction is 36. So this is 19,000. His annual allowance is now 19,000. Coming to David. David, remember this is more than 312,000. So automatically this would be 4,000 because you can reduce 36,000. But if you want to check, you can check. Put 318 here minus 240,000 into 50%. If you see, the answer is 39,000, but you can't reduce 39,000. The max you can reduce is 36,000. So it will fall down to 36 and hence this will become 4,000. So now the AIA for not AIA, AA, 40,000, 19,000 and 4,000. This is the summary. Now, planning with pension contribution. So, spouses should be looking to make pension contributions. If contributions are not to be made equally, at least make sure the higher rate taxpayer should make the contribution. And note that a contribution by a higher rate taxpayer with a dividend income may achieve a saving in excess of 40%. Why? One, they are going to get a higher rate relief because we are going to extend the basic rate band, and dividends could fall in the basic rate and achieve a further tax saving. Okay. Now, taxpayer with income in excess of 100,000 should try to make the pension contribution so that they can avoid the reduction of personal allowance. Remember, from your net income, gross personal pension contribution is deducted. If that amount is less than 100,000, your personal allowance are not reduced. So it's good thing you want to utilize 12,570, the full personal allowance. This is only possible if your net income is less than 100,000. It's just a net income. So don't let your adjusted net income be more than 100,000. How can you do that? You can only achieve it by making gifted donation or gross personal pension contribution. Now let us do a question on this. Illustration 2 and test your understanding 7. There are two questions. Illustration 2. Calculate tax saving if Martina pays 1,600 in personal pension scheme. Profit of 42,000, dividend of 12,000. So let us do that. First, trading profit 42,000 and dividend 12,000 will give you 54,000. Deduct 12,570 because this is less than 100,000 taxable income. So personal allowance is 12,570. 41,430. Higher rate. Okay. So now we'll separate this into non-savings and dividend because they are taxed at different rates. Okay. Now, so from 41,430, we'll take 12,000 out because 12,000 is the dividend, which is 29,430. This is non-savings. 12,000 is dividend. So now we'll tax 29,430 will be taxed at 20. It falls in the basic rate. 5,886. Now, dividend nil rate band is there, irrespective of the taxable income. Dividend nil rate band. So 1,000 at 0% will be equal to 0. Okay. Now, still there are some dividend at basic rate. Remember, what is the basic rate? 37,700. Out of 37,700, 29,430 went, 1,000 went. So the balance 7,270 would be taxed at basic 8.75%, which is 636. Now, dividend at higher rate, higher. So total it has to be 41,430, 3,730. What is the higher rate for dividend? 33.75. 1259. Add all, it should be 7781. This is the income tax liability. But remember, they asked you tax saving because of gross personal pension contribution. Remember, here they have told they have made 1600. They didn't mention it's gross. So I told you, if they did not mention it's a net amount, we have to find the gross amount, gross it up. So 1600 into 100 divided by 80 is equals to 2000. This is the gross amount. You have to extend your basic rate by this much. See, to find the tax saving, always whenever you have to find a saving or a loss, first find before the impact, then find after. That means before the contribution to personal pension scheme that we have done here. Now after the pension, then check the difference. That is the saving. Now, so we'll extend the basic rate by 37,700 plus 2000. Don't add 1600. 1600 is the net figure, which is 39,700. Now again we'll calculate what is the non-saving. No impact on non-saving. 39,430 at 20. 5886. Again we are calculating 1000 dividend rate ban at 0. 0. Now more 9270. Earlier dividend was charged 7270. Now 2000 more would be charged at 8.75%. 811. And 1730 would be taxed at 33.75. 584. If you add up, it is 7281. How much did you save? Earlier it was 7781. Now 7281. You are saving 500. Also, you are saving a tax at source. Tax save at source from 2000 to 1600. It's 400. So total saving is 900. Tax saving. There is an alternative calculation to this. What is it? Very quickly you can calculate a tax saving without doing this full income tax computation, because in exam it's very common. You will run short of time. So you should know the shortcuts. Just use the marginal rates of tax. Okay, that means dividend that was previously taxed at 33.75 will be taxed at 8.75. You understanding? So now first you are taking 2000, right? 2000 that you have paid the gross contributions. 20% of 2000 is 400. This is saved. This is at source. 2000 is the gross amount on that 20%. Next, just find the difference when we extend. Earlier it was taxed at 33.75. Now it would be taxed at 8.75. Only up to 2000, because you have made the gross contribution of 2000. So 500. So 400 and 500, 900. This is a very shortcut method and very useful. Wherever possible, let me tell you this, it's an piece of advice for you. In your ATX exam, always try to use through marginal rates, shortcut like this in your exam, wherever you have to calculate tax saving. Now, moving to test your understanding 7. So here it's about Emily having a salary of 130 and pays cash into personal pension. Remember, it didn't say gross, so this is a net figure. You have to find the gross figure. Okay, calculate the tax saving. So now let's do. The moment you see his income is 130,000. Okay, we'll see how much personal allowance will reduce. See, in my lecture 1, I told you the moment your adjusted net income is more than 125, 140, your personal allowance is nil to 0. So this 130 is more than 125, 140. So that's why personal allowance is nil, 0. So taxable income is 130,000. So we'll see without the gross contribution. Same way how we have done illustration 2. Calculate. Non-savings at basic 37, 700 at 20, 87, 440 at 40, 34, 976 and 4860 at 45%. 2187, 44703. This is the tax liability. Now, how much contribution? 24,000. Okay. Remember, 24,000 you have to gross it up. It's 30,000. So this 30,000, if you add, okay, this 30,000, what do you have to do? Deduct from tell me what should you do? One 30,000. If you deduct by 30,000, gross personal pension contribution, it's 100,000. So it's 100,000. It is not less than 100,000, but it's equal to 100,000. That means you are going to get full personal allowance of 12,570, which you can deduct from 130. So now 130 because of gross personal pension contribution. 117,430. You can even extend the basic rate by 30,000. So it is 67,700. Now basic rate 67,700 at 20%. 13,540. Then the balance. How much is 117,430? 49,730 at 40%. See, earlier it's more, now it is less. So what is the tax saving? 43, 44, 703 minus 33, 432. 11,271 and at source 30,000 minus 24. Gross is 30, net is 24, 6,000. Same like the previous question. Total saving is 17,271. Isn't it? Now, alternative calculation using the marginal rate. As I told you, always try to use the marginal rate. So now, earlier you didn't get a personal allowance. Now you will get a personal allowance of 12,570, which would be taxed at 40% because you are already having an income of 130. Okay, so this tax is saved by this personal allowance 5028. Next, income that would have been taxed at 45% is now taxed at 40%. So the difference 45 minus 40, okay, into 130,000 minus 125, 140. 125, 140 is the higher rate band deducted from 130. That means anything more than 125, 140 would have been taxed at 45, but now it is taxed at 40. That's why we are finding the difference 45 minus 40, 243. Then we are saving tax at so 6,000, 30 minus 24. And when we are extending the basic rate, earlier it was taxed at 40, now at 20. difference into 30,000 because we're extending the basic rate by 30,000. So there are two 6,000. This is at source 6624 and this. If you add together 17,271 is the same as this. Now we are moving on to new part. This was not there in your taxation. It's a new part which is added to your ATX syllabus. Spreading of employers' contribution, where there is an increase in the level of an employer contribution from one period to next. And this increment is over 210%. I repeat, 210%. It's such a huge number that I have to put more emphasis on it, right? HMRC then requires the tax relief to be spread evenly over a number of years. This is how it is done. First 110 in the current year, excess is dealt like this. Less than 500,000 all in current year, between 500 to 1 million spread evenly over 2 years, between 1 million to 2 million over 3 years, between more than 2 million spread evenly over 4 years. We'll do a question on this so that you understand. Now, additional contributions for existing pensioners are deductible when made. Now, where an employer has multiple pension schemes, remember, contributions are considered for each scheme separately. Don't add the contributions of all the schemes. Keep it separate. Now, this is the summary of pension contribution. It could be paid by the individual. Tax relief will be the lower of 3,600 and an amount. Okay, wait a minute. Tax relief would be on the lower of the gross contributions paid and maximum annual amount. Maximum annual amount is higher of 3,600 and 100% of relevant earnings. Relevant earnings means trading income, employment income, and furnished holiday accommodation. Investment income are not relevant earnings. Paid by employer. Whatever the amount employer pays, there's a tax relief. Then, individuals could go for personal or occupational. For personal, it is always paid net 20% of income tax. Basic rate relief is 20% given at source, and for higher and additional, we extend the basic rate and the higher rate band by the gross contributions paid. Gross. If the word gross is not in bracket, you always have to assume payments are made net. You have to gross it up. Make sure you know how to gross it up. Multiply by 100, divide by 80. Coming to occupational, it is always paid gross. So don't worry about occupational. Here the tax relief is given via a payee as an allowable deduction against employment income. If employee is the one who is making contribution, from the employment income, deduct. If the employer is the one who is making it, he could make in the occupational personnel. It is also paid gross. He also gets a tax relief. For him, also it's an allowable deduction. But for him, we deduct it from his taxable trading profit. And for employees, it is an exempt benefit. If employers contribute anything, it does not come as a benefit to employee. It is exempt. It will not be charged on employee. Unlike other benefits that employee used to give to employee, like cars, loans, house, accommodation. We have studied all this in lecture 2 under employment benefits. Now, so we are coming, whether it is personal or occupational from individual or occupational or personal from employer. If your pension is more than annual allowance, there is a charge. Annual allowance is 40,000 and annual allowance will be reduced if threshold income and adjusted income and both is more than 200 and 240,000. Remember, if threshold income is only more than 200 but adjusted income is less than 240, annual allowance is not restricted. Both has to be more. First check threshold income always, then adjusted income. The moment threshold income is less than 200, you don't have to check adjusted income. You will get full AA. Now, and don't forget to bring the unused annual allowances with the 40,000. 40,000 is for the current year, for each tax year. Okay. This also This annual allowance charge also we put it in the income category, like how we have for non-saving saving dividend. This is also one source of income. It is taxed after dividend, but at non-savings rate 20, 40, 45%. Remember, this annual allowance charge does not affect your adjusted net income, and unused allowances can be carried forward 3 tax years, only 3 tax years. And when you are carrying it forward, it's on a FIFO basis, first year, first out. First tax year, then second tax year, then third tax. So that means earliest tax year first. More than 3 tax years, you can't carry forward. It's wasted. Now, benefits on retirement. How do we access the pension? We have finished the tax relief. Now we are moving on the last part of this lecture. That is, when we retire or when we die, how do we access the pension? Remember, pension age is 55 years and above. Okay? Until then, an individual cannot access the fund. You have to reach the pension age to get it. And if it's an occupational, benefits are linked to the level of earnings of the employee. And for personal, it is dependent on the amount of funds accumulated in the pension fund. Example, contribution plus investment income or gain. Individual with a personal pension, they have a flexibility in how they want to access that accumulated fund. You might take all or some part of the pension fund at any time, provided you are above the pension age, not below. And you can still receive a pension and still continue to work. Now, when you're reaching a pension age, you can receive a tax-free lump sum. That means you're receiving a lump sum payment, but you don't have to pay tax. And this amount is maximum 25% on the lower of value of the fund and lifetime allowance. You can withdraw the balance of the pension fund anytime, but the part of the fund that you have not withdrawn will be growing in your account tax free. Any withdrawal, when you are withdrawing any balance of the fund, remember they are taxable income. They'll be taxed at 20, 40 or 45%. Now, coming to lifetime allowance charge. Even this is new for ATX. Earlier we studied annual allowance charge. Now it's lifetime allowance charge. Remember, there are no restrictions on total contribution. But funds in the scheme, if it exceeds the lifetime allowance, when you are taking the benefit, tax is charged on the excess. For the tax year 23-24, that lifetime allowance is 1,073,100. If you are exiting any fund in the scheme, it will be taxed. Okay. How much tax charge? 25%. 25% on the excess. And where the taxpayer chooses to take the excess in cash, tax charge will be 55% of the excess. Remember, when we are taking the excess of the fund, that means anything more than 1,073,100, and we are using it to fund a larger level of pension income. This is known as annuities. For that, on the excess, 25% is charged. But if we are taking it as a cash, if we are taking the excess as a cash, then the tax charge is 55% on the excess. Now, let us do one final question before we conclude this lecture. Illustration 3, life allowance charge. So we have part A, part B. We have to show the tax consequences if excess fund as a lump sum, if he takes the excess fund to buy pension income. Okay. Now, his fund was valued, pension fund was valued 2.7 million. So now let's see part A. It's more than 1,073,100. Find the difference because the excess will be taxed. Okay. which is 1,626,900. Now we have lifetime allowance charge. Remember, he has taken a lump sum. That means a cash. So it will be 55% on 1,626,900. 894,795. 732,105. This is the amount he will get. Okay. Now B. Excess would be same, but this will be now taxed at 25%. That is the only difference. Everything else remains the same. And whatever the pension income Thai is receiving will be taxed as non-savings. Okay. Benefits on death. Even this is new for ATX. So when an individual dies, the pension scheme will give pension income or a lump sum for the dependent. Now the dependent could be spouse, civil partner, children under the age of 23 or other dependent. There are further tax charges. Depend on the individual's age, depends on the individual's marginal rate of income tax, and whether the scheme is a money purchased or defined benefit. Whether any of the fund has already been utilized to provide benefits. Now, remember, calculation part will not be asked when we are dying. It is only the theory part. Now, so let us summarize. When you're retiring, tax-free lump sum, and you can withdraw as income. When we are getting a tax-free lump sum, 25% on the lower of capital value of the fund and lifetime allowance, that is 1,73,100. Now, when you are withdrawing as an income or a tax-free lump, if the fund value is more than 1,73,100, excess is taxed. If it's a lump sum, 55, and if its income is withdrawal, 25%. Lump sum is when you receive it as a cash. Now, the overall pension scheme. So employed, self-employed, employed, occupational, and personal. Personal could be done for non-employed people also. Under occupational or personal, we get tax relief. The way we obtain is different. Okay. Then there is an income tax charge if it exists the annual allowance. Annual allowance is 40,000 current year, but we might have some unused annual allowance brought forward, which we add with 40 and check. Then benefits from the scheme. So individual and employer will get the tax relief. And for employer, contributions could be spread. We have checked based on the amount for how many years we have to spread. And then benefits from the scheme on retirement, it's a flexible, on death, and lifetime allowance charge to tax. Now, thank you for watching, and I shall see you in the next lecture. By the way, with this I have come to an end. I have finished my income tax. Now we'll be moving to a new type of tax, capital gain tax. Yes, you have heard it right, CGT. So my next lecture, lecture number 8, will be on CGT. So I'm hoping to see you there. Don't forget to subscribe to my channel and do watch my other lectures on my ATX playlist. Thank you and take care.